Just to reiterate, just because it's something important, recording, getting some additional funds so that I can keep this going, and I can forward the Bloomberg where I get some of the data, or a lot of the data, or at least the way they spit it, they break it apart. Reach out. It's only $500 a year at an entry level. That gets you a lot of access to my insights outside of all these fun things. And then we will be adding your ability to get these slides as well for both the EIA show and Econ show. So reach out. Your support is always helpful and appreciated. So one of the things that we want to look at is obviously what's happening with OPEC supply, what's happening in general. So now we're at the point of the game where people are going to start to speculate, what is Saudi Arabia going to do? What is OPEC going to do? Because we are going into the OPEC meeting being next week. So one of the big things is what they have a voluntary cut. They cut 1 million barrels a day in July. They cut 1 million barrels a day in August. What does September look like? And as you can see, based on the data that we showed prior, that takes you through the middle of July, as we'll show you data going forward, that will show you data that is current, where there hasn't been a huge benefit in terms of trying to take some of this crude off the water. It drove up prices, it pushed people away from buying. So realistically, we see them maintaining some of the cut. If for those that have been watching us, we thought that August Saudi was going to cut just 500,000 barrels, not a full million. We do think that that's going to take place in September. They will maintain some of that voluntary cut. It won't be all of it because they're missing out, and we'll give you some of the price fundamentals on what we mean by missing out. So as you can see, as of June, the OPEC quota and voluntary cuts took them to 37.9, which is where they could be. Right now, they're sitting at actual output of 36.7. So you get an idea of kind of where things are in the different levels. But now you have to factor in that there has apparently been some headway made between the Iraqi government and the Kurdistan government, which would bring about 200,000 barrels online. The CN pipeline is about 430,000. But remember, right now, Iraq is actually producing below what they're allowed to produce, and is actually is reflected in the output quota, voluntary cut, and actual output. So they do have some room to increase production by about 200,000 barrels. So right now, let's just take Brent sitting at about 83. 83 is with CPC showing some additional downtime. Forcados coming out of Nigeria, showing some additional problems in terms of trying to bring online. So you're seeing some of this. This is with 83 is with now Saudi out of the market for an additional million in all of July. We're in July 26th. For all of August, you're still not seeing this huge shift. Technically, Russia has dropped some of their production, some of their exports of crude, but as we've been saying, they've increased their exports of refined product. They increased their exports of diesel. It's pulled back slightly from the record of 1.17, which was at the first half of July. Right now, they're averaging 1.16, but it's still a very high number. And what did Saudi get for this? So now when you look at some of the numbers, so Saudi Arabia's oil exports fell to the, revenue fell to the lowest in over a year in May. So then June, not much better. So then you look at July and August. So when you take the benefit, so taking the average from June until now, and then when you take it from July and from May until now, and then June until now, when they announced the cuts, they were only able to make an additional 46 cents, just taking the average of Brent. That is by no means the only way to do it. It is a very haphazard, quick and dirty way to do it. They've obviously made more money at the back end of it than the front end of it, but you're getting an idea that there is still loss within that, which is, and even though they've cut back that amount, they haven't made it up by increasing the things exponentially. So there is that give and take, because if I cut 1 million barrels out of the market, and then I make an additional $5-6 on all of my other barrels, that makes a lot of sense. That's why we do see this continuing a bit into the future, because they're going to try to make back some of the money that they lost based on some of this announcement and the slow start to some of those price increases. When you look at the IEA and the EIA, they now both see supply deficits for 23 and 24. The biggest issue that we have is not so much on the world supply. The supply thing is we see that, we get it. It's on the demand front. When you look at the fourth quarter and you look at some of these expectations of 105, 104 and a half, we struggle with some of the demand levels given where the market is. We've seen a lot of pressure when you're looking at, the economic data for industrial manufacturing, trading. Services is really starting to roll over. The service side or the consumer side, it's still positive, it's still expanding, but at the rate of change is slowing down, quickly, and we do see that accelerating to the downside. So Europe is already in a recession. You're already starting to see some of these underlying problems when you're starting to look at different flows. They've started to shave some of their activity when you're looking at refining. And then when you look at China, China, the SOEs, refiners there are not operating at normal. They should be at about 85, 86%. They're at about 80 right now, 77 to 80. The teapots, the Shandong, should be at about 67 to 68%. They're currently at 59%, but yet they're importing a ton of crude. So again, we're not seeing this huge, there's no reason why China has to continue. They're putting a ton of this into storage, and at any time they can say, yeah, prices are too high, we're just going to pull from storage, and they'll just bring down their imports by 1 million, 2 million barrels. They're never going to take them to zero. That's not how this works. But instead of bringing in 14 million barrels a day, they'll bring in 12. They'll bring in 11. And they'll start to pull some of that down, and that's where you'll see some of that crude left in the market, which based on where floating storage is, crude on the water is, that's a big number that is not going to easily be absorbed. So then when you look at India oil product exports, fairly in line with where it has been in the past. That's not a huge change, when you look at exports, just because they're trying to balance it out, bringing in Russian product, that is by buying at a discount, export product at a nice premium. When you look at imports, they've been importing more. A lot of this is coming from Russia. They're just importing Russian product because, well, why are we going to use our own product when we can import theirs at a discount and export as much as we can? So again, this is something that is taking advantage. This is on the distillate side that is being at a stronger point. So this is as of June. So it's just an important piece to see in general. Now, when we start looking at China crude versus refinery runs, this is taking us July 26th. So you can see that total crude available in refinery runs, there is a huge disconnect. So there is a sizable amount of product in July that continues to come through, because look at the refinery runs actually falling. We should be tipping higher, not down. So when you look at the amount of product, or I should say the amount of crude going into storage, our estimate was at about 985 million barrels. I mean, by the end of the month, and as we head into August, they're likely going to be approaching about 1 billion barrels in storage. So at any time, they could say, prices are too high, we're just going to pull back, which is also something that Saudi needs to address when you start looking at, as we progress into the fall months, because normally this period of time and into August, China slows down buying. So we should see them closing. That's not crazy to hear, to see them slow down. The question is, are we going to see them slow down the same way? Is it going to be a bit higher? And that's something that we're going to discuss in a minute. So global crude oil on the water still at record levels. That's not going to change just because Russia has to dump everything into the ocean. Iran is exporting the most that they've exported in a long time. Not the most ever, but most in a while. A lot of it's being flagged as Malaysian, as we showed last week. But again, you're still getting a sizable amount on the water. Crude oil in transit is ticked up. So remember, if it goes up in transit, we should see a bit of a decline in floating storage just because it's going into motion. So some of those declines, are offsetting. And that's something that we did see when we look at some of the floating storage side. But the floating storage side, when you look at it, we're below where we were in 2020, but we're at crazy levels in comparison. Like, we should not be at these levels if the market was so tight. Now, it's not that it isn't tight on certain grades. It's just when you look at the market in general, there is enough crude out there to fill the needs, and nobody's chasing. Like, there is nobody out there that said, that Nigeria, West Africa in general took the opportunity, gunned rates, gun prices, and people slowed down their buying. And things started out fairly strong for Angola, fairly strong for Nigeria. I'm not Nigeria, for Angola and Congo. And buying dried up. So at some point, you're going to have to see some of those prices come back down, because they're going to have to try to clear some of this glut, because we are in July. The new loading program starts in only a few days, and we need to see some of this start to clear. While, yes, Russia seaborne crude shipments on the 4-week rolling average, you're seeing things kind of balance out. They're not at 3.8 million barrels, but they're also not at, they're not at 2. So when you start looking at the balancing side, so yes, some of the crude shipments have come down, not a huge amount, because when you look at what has increased on the distillate side or diesel side, it starts to balance out a bit. There's still a net decline, but not as what it would seem when you just look at that white line. And then when you look at seaborne crude shipments, you get an idea that things are kind of balancing out. We're starting to actually creep back up. And on the 4-week average crude shipments from Russia by destination is actually back above where it was to kick off July. So again, you're starting to see some of that adjustment, because they're just trying to manage their system. And it's not like we're all of a sudden getting this huge drop, which is why we see some of these pressure points when we look abroad. From the Pacific, when you look at what's been coming through, weekly crude shipments from the Pacific side, you can see have increased. So even though it's decreased from the western side of the country, you're actually seeing an increase from the eastern side. And again, this all balances out. And that's what we keep trying to say. It's not that, they keep talking a good game. They keep trying to, move. It's like 3-card Monte. It's like, trying to find it. It's like they're just playing a game here. And when you look at it, has it come down? Yes. It's come down probably 250,000 barrels, not the 500 that they're claiming, which is why we continue to see some of these pressure points, especially as the Middle Eastern crude floating storage is now above where it was in 2017, obviously below where it was in 2016, but it's approaching the 2023 highs. And, when you look at UAE crude, UAE crude is starting, or Dubai is starting to trade at a bit of a discount, trying to compete. And you're just not seeing these movements, because when you look at the pricing schedules, why would you ever buy Saudi crude at this OSP? U.S. crude is cheaper. Even when you factor in insurance and shipping and rates and distance, it's cheaper to buy from the U.S., which is why we do see more of this going into storage. Then when you look at the spreads, fuel oil crack spread still remains in support, just because, again, we don't have a lot of that heavy. Naphtha is still stuck, where it's as you get topping. So what naphtha can go into the steam cracker at the petchem, or into other areas within the refiner, being reformers, alky units, topping units. And when you look at gasoline, there's no reason to crack naphtha for octane. It's just you have so much gasoline, you already have this component, so you're going to try to push it into the petchem stream, and the petchem stream is like, look, we don't want it. We have more than enough propane and ethane available. Keep your naphtha. So now you get these cracks. Then you have Russia at record numbers, exporting naphtha. So there's more than enough, which again is pushing down that light sweet, pushing down that topping side. When you look at the lighter end of the barrel and lighter barrels, but you're still getting some of that tightness at the medium and heavy side, which is starting to slow down. It's still tight. I am by no means saying that the medium and heavy side is weakening and here's the implosion. No, but some of the heavier crudes, medium crudes from West Africa are not selling, and they should be. And the fact that they're not is showing that you're starting to get some price sensitivity. Nobody's chasing that barrel anymore, which again will push some of those physical markets to decline. The U.S. rolling four-week average for crude fell a bit. We still think that exports are going to average 3.7, 3.8. Like we said, this is very competitive going into Asia. We don't see that changing in the near term. When you look at crack spreads for gas oil in Asia, huge spike back to 25. You're going to keep guys moving through until China does what is the capitalistic thing, and I know it's not a capitalistic country. You should be hitting that. You should be hitting that bid. China has been buying Russian crude and Iranian crude at a discount, and you have the ability to sell diesel and distillate and gas oil at that price all day. You should be doing this all day, but they're not. And let me preface this. They've started to. Now, I think as that builds up and you start to see some additional builds into Singapore, and we'll show you China's flows in general, that will help adjust. But you're still going to see, this is going to support additional activity. Now, this is what we were talking to you between Dubai and Brent at negative 34 cents. Again, this is a problem. Brent is starting to see some builds. Europe is starting to see some builds. They're going to try to find ways to clear this Dubai crude, and you're just going to continue to see it. It's trading at a discount. This will be good for the UAE, a problem for KSA, and that's going to be an interesting one to watch. But it's imperative to look at this holistically, because there's the crude side, there's the product side. So I just took the whole screenshot just so you can kind of see where we are, how we broke it down: international, Asia, China, exports. Here you can see that big spike into the amount of product as we've defined it as gasoline and distillate. This is going to be distillate heavy at this point. You can see they're back to the highs of those exports, which, given where crack spreads are, it should be. And you're starting, I'll read you through some of the comments from Fujairah. People are starting to see this, and that's where you still have the east to west arb closed. So you will see some of this get put into storage, but until you see that go into storage and those numbers reflect, we will get that tonight into tomorrow from Singapore. You're going to get some of those pressure points in general. Asia floating storage, dipped back below 2021. We thought it was going to track closer to 2022. Right now, it'll likely split the difference. It will be higher than 22, but below 21, just as you get a bit of that balancing act. But as long as refiners stay fairly underwhelming, you're going to see, some of this stay sticky. The only way that you're going to get, and the reason why we think it doesn't track 2022, is we do see some additional slowdowns in crude imports. But it's important to understand there's normally, and you can look at the trend. So the trend has been moving in the right direction. Just China's been importing way more than it normally does versus any time outside of 2020. But as currently Brent sits at 83, well, there's no real impetus for them to continue to buy at 83. So they could continue to roll this down, pull what's off the water, pull what's in storage, and all of a sudden you're going to see some of those pressure points. And again, that's why we do see this moving back down to the lows. Seasonally speaking, it'll be kind of right around average, but still, they're still importing a lot, and a lot of it is going into storage. When you look at the Shandong independent refiners, last year they were operating at 69.4%. They normally 5-year average is at 64.5. They're sub 60%. I mean, you're looking at teapots that are sitting there not creating product as more and more of this crude just gets shoved into storage, which is why we see some of these slowdowns. And in general, when you look at China congestion, the 100 line, because it doesn't go back, it's indexed to 2021, and 2021 was not exactly a great year when you look at Chinese demand for driving. But 2022 had a lot of mixed lockdowns. You had lockdowns in different areas, because remember, 2022 you still had zero COVID policy, and yet you're getting China congestion tracking 2022 levels. That's not supportive of this huge surge in demand. As we've been saying, especially on the last several weeks, in our China shows on the which is segment 5 of the Econ show, there's not a lot of great demand coming and economic data coming from China. So again, we think that that's going to remain a problem. One of the things that we had said, we expected West African crude floating storage to drop, because as you can see here, it set a record for 2023. It set an all-time record, seasonally adjusted speaking, and it's still staying flat. And based on the new numbers, not much has moved, which is going to be a concern in general when you start looking at those pricing, some of that softness in pricing coming in, and why we think that you're going to get a bit of that downward move in underlying crude and especially Brent. But again, the physical market should show some diffs getting a bit looser, pricing coming down, because there's still cargoes out there in West Africa, in both Congo, Angola, and Nigeria, that have to move before the loading starts in August, which is why we do see some of that pricing coming down. Crude oil exports in the U.S., gasoline exports dropped 78,000 barrels. It's still 327,000 above the 5-year. That's a lot. We expected that to drop harder. It has not. Clearly, they're finding some demand out there, and the U.S. is taking advantage of it going into Latin America. They're also trying to manage their own storage, because gasoline is very high, is very elevated in PADD 3, given where demand is. Not that it's massively elevated based on storage, but based on demand, where things are. And the bottleneck of going through the Colonial Pipeline, through the Jones Act, is why we're seeing that continue to flow south. Disti had a drop of 166,000 barrels a day of exports. That's 17,000 below the 5-year. The ARB is still open, so we should see that maintain. It's not that it's going to surge, but we should see it maintain that 5-year at this point. And then when you look at propane, propylene, an increase of 76,000 barrels. Again, 440,000 above the 5-year. We're just going to continue to crush it, just based on how we're competitive into the global market. And then crude oil exports, big bounce from 3.8 to 4.59. For those that have been listening to me, we physically can export 4.59. We don't have the infrastructure to do it. So again, that's where you get some of those impacts, as we highlighted in segment 1 on the adjustment factor. That adjustment is going to come through because it's overstated here, understated not so much last week, but the last 2 weeks before. So July, in theory, realistically has been understated on exports. So again, understated on exports means that there's going to be more draws in PADD 3, which is going to bring that adjustment factor down, just because it's the export numbers are trued up not weekly, but monthly. So this is just trying to gauge based on filings and everything else, and it's lumpy, especially as you get into the end of the month and beginning of the month, which is why you have that true up. So don't fret. It's not massive, inner circle manipulation. I promise you, it is normal. As I said, when we started exporting crude, those numbers are going to get lumpy because of just the way it's looked at the import side and the export side. Gasoline, you can see still staying at the highs. That'll trend down, but still going to stay fairly strong. When you look at the disti side, it's going to bounce around, but still stay at the 5-year, especially given, where gas oil draws continue within Europe. That's going to, again, draw more into that part of the world, which is why we'll see some of those flows continue. Crude oil exports, again, back to where it was. LPG, seasonally adjusted all-time highs, again, still staying at the highs. We don't see that changing. Ethane, same thing, staying at the very top end, right at that top of the cloud. It's going to continue to trend higher, especially as additional ethylene capacity comes online, ethane steam cracking capacity comes online in China, as well as the Middle East. This is where you're going to see those flows. Now turning to Fujairah. Fujairah had a build of 1.924 million barrels, came in at just over 18.7. And the stock movement saw a rise in light distillates and heavy resid. Light disti had an increase of 66,000 to 6.23. East of Suez gasoline complex strengthened a bit on the back of the unscheduled refinery turnarounds. Indonesia gasoline imports increased a bit. But when you look at it unchanged on the month at 10 to 11 million barrels, despite the end of the July school holiday period, some market participants added that Indonesia gasoline demand was expected to remain consistent, rising temperatures amid healthy inventories. Moving forward, some market views said that Indonesia gasoline import demand could fall amid rising gasoline prices. And gasoline prices is where we've been talking about, where as gasoline prices go up, you're seeing that drop, especially as some of the governments are reducing the amount of subsidies available. Middle disti fell 19,000 barrels to 2.8. East of Suez gas oil market backwardation steepened, though recent spot activity indicated weakness in the physical cargoes, which continued to be weighed by surplus barrels trapped in the region on unviable east to west economics. That's what we've been talking about. East to west means that we're not seeing the flow coming from Asia, coming from the Middle East into Europe. And that is going to show up in this. And we're at a very low storage level. I'm not saying that we're going to get this massive spike in storage, but it's going to put some softness. And then as China starts to hit that bid, that's going to, again, push things down. Demand for gas oil was weaker than usual, even though consumption in Europe usually tapers over June and August in the absence of heating requirements. European gas oil demand continued to feel pressure from economic headwinds, with the downturn in Eurozone manufacturing reaching new lows in June. And that's where, again, we continue to see those pressures. Heavy resid rose 1.877. Spot trading activity was thin, and again, because shipping is fairly low. And as we said last week, we expected builds across all three. We expected the biggest. For those that watched us, we did expect the biggest in heavy, and here it is. So now we'll see a little bit of a build in middle and light, and likely a bit of a draw in heavy. The time spread, tightened up a bit. You can see we're back at 39, 39 cents. Bit of that backwardation getting a bit higher. That's, again, kind of makes sense when you look at some of the shifts that have happened in general. We do see that softening a bit, but again, still staying kind of between where it was in general. Nigeria, small increases from August into September. Angola, small declines. So far, when you look at what's happening from Russia, they've stopped reporting this, so it's just a matter of tracking what you can. And Libya is continuing just over 1 million. Now back to the West African sales. Fewer Nigerian crude cargoes for August loadings. Are still looking for buyers, largely because several have been deferred into the following month. So again, July looks better because they deferred. They couldn't sell them. Angola's last remaining shipment for next month are proving slow to place. Nigeria, between 8 to 12 shipments for August loading, are still searching for purchasers out of the 45 planned, where that compares with 16 unsold as of July. That more than 80% were unsold as of July 7th. The unsold tally has declined this week, mostly due to multiple cargoes being pushed into September. So again, it's not that they sold, it's just they pushed them out. And those are sitting in storage. That is expensive to do, and that's where we see some of those underlying problems. About 2 to 3 cargoes of Angolan crude for loading next month are yet to find buyers. Rate of sales is a little slower than normal, given the preliminary plan for September is out. 2 consignments for Congo are still looking for purchasers out of the 7. Again, none of that is bullish, and that's why we continue to see some of those underlying pressure points. Europe had a sizable build. It actually took it to the highs. The only time it was higher was in 2015 and 2020. So again, we do see some of those increases, and you can see we're back to the high for 2023. We do see that creeping higher given the pressure on refining, the slowdown in refining and the amount of crude still slated for import. When you look at inventories, we're over that 1,400,000 tons. Gasoline build 66. Gas oil had a small build of 59. Fuel oil, small drop of 129, but again, still very elevated. Here you can see gas oil, small increase, but still at a very bullish point. So they're still going to struggle and they're still going to look to refill. Gasoline, back to 2023 highs, highest of all time, seasonally adjusted. We see this again creeping higher until they're able to dump this or at least move more of it into the East Coast or Pad 1. Fuel oil, small drop, but a lot of this is reblending, especially they're trying to blend this back in. That west to east arb is closed. There's no reason for it to come through. More pressure is going to come into the Atlantic Basin as those Russian cargoes of gas oil disti come into the Atlantic Basin, which is going to displace some of those U.S. exports and displace where some of those flows go from Europe. Again, complicating things further. Then when you look at total stockpiles in Singapore, they've continued to come down, which is a good thing. Light distillate, nice drop. A lot of that is that pull that we've talked about from some of the Asian markets. We do see this pivoting back up. And it's interesting because we saw something similar happen in 2017 and 2021. And we do see a bit of a spike. When you look at that middle distillate, it's going to stay bullish here. We're at the very low end. It'll start to creep higher, but you're starting at such a low rate. Even as China continues to put more barrels in, you're still going to see this stay at a fairly low level and support some of those crack spreads. Then when you look at the resid side, in general, resid continues to trend a bit lower, but as we've had some of those slowdowns in Singapore and Fujairah for shipping, this will just trend back to that 17-year average. North Sea crude in storage starting to creep back up, getting back to the 2022 levels. And again, that's that pricing metrics we're talking about. You're starting to see some softness come in. Still, diffs are higher, but then they haven't really started to fall yet to move some of these cargoes. So we do see some downside. And then Europe, that pivot back up, again, supporting why we see a bit more of those imports coming in into Europe, pushing some of those levels higher as refiners slow rates. We did get a fire in Repsol in northern Spain, in the northern Spain's refining complex. Repsol owns it. That, again, is going to slow down some of the underlying demand on top of just general adjustments that we've already seen. So that's what we have for you today. If you have any questions, please feel free to reach out. We'd love to hear from you, and we hope you enjoy the rest of your week. And we'll talk to you tomorrow with our Econ Show. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.